When inflation surpassed the central bank's target of 5% in January this year, many thought it would be temporary despite a consistent increase from 3.18% in October 2010 to 5.42% in January. Fast forward to August 2011 and inflation has now peaked at 16.67%, a rate which is not only 3 times above the CBK target but closer to the 20% predicted by some analysts less than 2 months ago. Higher inflation has strained household budgets, with expenditure items such as food, transport and utility bills shooting through the roof. According to the Kenya National Bureau of Statistics, the average cost of a basic meal of ugali mboga has risen from 54 shillings and 54 cents in August last year to 68 shillings and 36 cents this month, threatening to make even the most basic of meals unaffordable to the majority.
What it tells us is that our national systems of trading in goods, especially these critical commodities, are not competitive and they're not delivering the right prices for Kenyans.
Despite the prices of a few food items such as maize flour, potatoes and sukuma wiki marginally reducing during this period, the impact has been negated by corresponding increases in the price of almost everything else, most notably sugar, which coupled with a weak shilling may create a recipe for social unrest should the gap between the haves and the have-nots continue to widen.
Part of what we see as weakness in the shilling comes from the fact that people anticipate that we are not dealing well with inflation.
And although the future appears bleak, the central bank is optimistic that inflation will slow down to 7.5% by the end of the year, easing the burden on declining household incomes. Wanjiru Gaitho, Citizen Business.